Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'll continue talking about capital budgeting. So, if you missed my last episode, I was talking about the different things that we could use for assessing if projects would be a good investment or not, and here we would decide where to put our money, basically. I gave you some tips on using NPV or IRR. I also talked about the opportunity costs and the limited resources that a company might face. And lastly, I also addressed the issue of using discount rates and perpetual growth rates. So today we're going to continue talking a little bit about the discount rates, which are going to be important, and especially the company's discount rate. So if you've been following up with my episodes, the company's discount rate is usually referred to as the WACC, W-A-C-C. And this, you get it from a long equation that I can put in the comments, but I've talked about it before, and it's basically talking about a couple factors: equity, debt, the cost of equity, the cost of debt, and taxes. So you have these 5 factors that are affecting the WACC. So how, if possible, can you change your own WACC? And why would you like to do that? Well, for a couple of reasons. If you manage to, as a company, lower your WACC, this is going to raise your company's fair value. And therefore, the entire firm's value is going to go higher, which is something that, of course, everybody is aiming to do. But before we go into all of that, I'm going to start talking about all of the parts of the equation that are going to be under our control or that we should consider and have special care when looking at them in the equation. First thing would be taxes. And why is the first thing for me? Because taxes are out of our control. So this factor, we're going to push it out. We don't really care about it. The only thing that you should consider is that the WACC is forward-looking. So you should calculate the tax percent that you're going to be paying in the future. So whether that is somewhere specific or some reforms are going through, then you should consider the future tax rate. But if not, which is the normal situation for most companies, then it's out of our control. So we're going to take away that tax percentage because we can't do anything about it. Now, let's focus on the equity. Equity is going to be very important, and here is one very good hack that I could give you, and it's never use the book value of equity. As you remember from my accounting episodes, we were looking at companies like Starbucks or McDonald's that in their books, which means in their financial statements, they have negative equity. So how can this be possible? It makes absolutely no sense. And all of this is basically because you can do share repurchase, share buybacks, stuff like that. Some stuff that is going to make your equity value lower. A company that has a very low equity value, not negative, it's Apple. And that's why all of the ratios regarding Apple are seeing a ginormous return on equity. Not because Apple's not growing a lot, but it's mostly due because their equity is very small. So of course the return is going to look very, very big. So you should always be careful with the book value of equity. And that means the book value is the one that you see in the financial statements. You should never use that one for doing any of the WACC calculations because this one's going to be misleading. So you should use a proxy, such as the market value, which can be the market cap for a publicly traded company, or if it's a smaller firm, then you can try to estimate it in a different way, but be careful to not use the negative book value, especially. I'll give you a second hack, and it's related to the cost of equity, because here what happens if you don't have a beta? Let's go back. Beta was how sensible you were to the market. So a beta of 1 means that you moved exactly like the market. Beta of -1, which is kind of impossible to have, would be that you're moving the exactly opposite way from the market. But then most companies would have a beta. It can be negative, but they have a beta that's usually either close to 1 or a bit higher to 1 when they are more volatile. But how can you calculate all of this if you don't have a beta? One easy way might be to first find an industry benchmark, and then once you have, 5 companies, 10 companies that are going to be similar to the one that you are analyzing, you are going to unlever the beta to the industry average. And I'm going to talk about levering and unlevering later, but this is going to be related to the proportion of debt to equity. We're going to unlever these betas, and then we're going to take an average on those. So as soon as we have an unlevered average beta, we can take it as our own and then re-lever it to the firm's target leverage. So if you're getting lost in the process, leverage, just in case, because I didn't mention it at the beginning, is going to be the amount of debt that you have. So we're going to have to take all of the unlevered beta from all of these other companies because we can't have the same structure as they have. We're going to take the unlevered one, and then we're going to multiply that one through our own leverage structure. And this is going to relever the beta, and it's going to give us a good measure that we could use for calculating our beta. And now, my third hack is going to be related to the cost of debt. So cost of debt is going to be something sensible because we're going to always look for long-term cost of debt. It should always hold the most updated information. So also ideally not the book market value of that, but maybe the market value. And then you should always try to make it in the same currency as the cash flows that are being analyzed. And why am I bringing this up? Because for analyzing US companies or Canadian companies, it's very easy. But I'm from Colombia, so how can you analyze companies that are not having bonds being traded in their markets as easily, or that have different currencies in their financial statements? This is going to be relatively harder. So for cost of debt, always try looking for these 3 things. First, long-term cost. Second, updated information. And third, same currency. Now, for getting this value, this may not be easy for all companies. So I have, let's say, like a 4-step guide for getting it. And so the first thing that you should do is, of course, look at the firm's most updated information on bonds. If there aren't any clean bonds, let's say from the company, we can use bond ratings to estimate what the value would be. Because if you have seen before, all of the companies may have a rating. So they might be BBB or AA or AA+, depends on Moody's and all of these companies that are rating the risk levels of debt. We're going to get a rating, and that one is going to give us an estimate on what is the cost of debt. If there aren't bond ratings for your company, third thing you could use would be the bank ratings. So banks also have some of the ratings for assessing if people are going to be very good at paying their things or very bad. So this would be the third option. And lastly, if you don't have a bank rating, then you would have to use your own rating. But this would be only if you don't get any of the information. So you can either try looking at your own bonds, looking at the bond rating, looking at the bank rating, or looking at your own rating. So the thing that you can take, the overall conclusion would be that we want to have this cost of debt as updated as possible. And so I left the fourth and final element for giving you the last hack till the end, and it's debt. And why did I leave it till the end? Because debt is going to be the factor that we can use the most for changing our WACC. And so I'm going to start talking about debt or leverage as if they were the same word, because in finance you will find that many people are talking about leverage, but this just means debt. So debt is going to be something that will change your capital structure, and therefore, since you're changing this little mix of how much debt and how much equity do you have, you're also going to change your beta. And here you may think, whoa, what's going on? Wasn't our beta related to equity? And yes, but if you have more leverage, you are incurring into more debt, this will mean that you have a higher risk. And if you have a higher risk, then you'll have more volatility on your cash flows. And more volatility means beta might go up. So changing the leverage will definitely produce a change in the WACC because you're changing the amount of debt that you have, but you may also change lots of other things in this mix of factors that we're using. But the thing is that you can't really know if the WACC is going to go up or down just by increasing your debt. It depends on the amount that you increase it or the amount of the other values. We just know that it will change. We just don't know in which direction it will change. But so, for knowing in which direction, the only way, sadly, is to do the math. You'll have to calculate it to see what your effect of your new amount of debt will bring into your company. And so for doing this, I have 4 steps that are going to make it super easy to calculate this new amount of debt. First, you should always get your beta. And if you don't have your own beta, again, I told you, you can do an industry benchmark. So this one's going to be relatively simple. Second, we're going to unlever the beta. And I was mentioning this process earlier, but unlevering beta is going to mean multiplying beta times equity over debt plus equity. So this is going to mean unlevering the beta. And I'll repeat it again. Beta times equity over debt plus equity. This is going to be like the equity proportion of the capital structure. Then third, you're going to think of your target leverage. So let's say I now want to have 30% of debt in my company. That's going to be my target leverage. And so the fourth thing is that you're going to re-lever your beta with this new value that you want to have. So we'll take the unlevered beta, which is the number we had from step number 2, and we're going to multiply it times 1 divided 1 minus your target leverage. So I was telling you maybe my target leverage might be 30%. So in this case, it would be 1 minus 30 means 70%. So it would be 1 over 70%. That would be the only thing you have to do. And that would give you a re-levered beta. And with that new beta, you can just plug in the numbers. You'll now plug in your new amount of debt, your amount of equity, your new beta, and after all of the calculations that I already explained in my previous episodes, cost of equity, cost of debt, the WACC, you're going to all of this long step, and this is going to let you know if the WACC went up or if it went down. And so remember, our ultimate goal is for the WACC to go down. But finding this is going to be very hard because there is an optimal level of debt that companies want to achieve. And for it to be optimal, it should mean that if we have very little debt or a lot of debt, both of those corners are going to be bad. We need to find the middle point. But for finding that middle point, we're going to start talking about the optimal financing mix in my next episode. And here we'll start going into the second decision that we should take with corporate finance, and is how much leverage should a firm have, and how are you going to raise all of the money that you need for doing all of the investments that we already assessed in this first decision. I'll see you next week.